What is happening, best ever listeners? This is Matt Faircloth, and welcome to the Best Ever CRE show. And you might think, wait a minute, it's not Friday. Wait a minute, this is not my buddy Matt bringing me the next level CRE segment that he does on Fridays. Quick plug to listen to the Best Ever CRE show on Friday. It's not Friday, and that's okay. We're introducing two new hosts. I'm bringing new magic to you guys. New thunder coming down the pipeline because I've got two new best ever host and a co-host coming at you guys to teach you guys, do you want to make money? I want to make money. I want other people around me to make money. How about that? So if you believe in making money and putting money to work into great things, this is your show, right? So today we're going to be introducing a fellow Hokie. That's right. I'm going to throw a lot of Virginia Tech in today's episode because my man, Chris Lopez, there's supposed to, Chris, there's no such thing as a former Hokie, is there? Right?
No, it's Hokie for life.
Yeah, Hokie for life. Even if you went there for like a week and then dropped out, you're still a Hokie, right? So my man, Chris Lopez, and his business partner, Richard McGirr, are joining me today on the Best Ever CRE show. But they're not joining me. They're joining Best Ever CRE. They have drank the Kool-Aid, folks. They are our new hosts for the Best Ever CRE show. So, Best Ever listeners, give a big like and a subscribe to this show so you can check out our new hosts, Chris Lopez and Richard McGirr. Welcome to the show, guys.
Glad to be here, and most importantly, honored to be here, Matt. Big thank you to you and the Best Ever team, man.
Yeah, thank you, Matt. It's really amazing to be here.
I'm pumped, man. Best Ever listeners, check out. I wish I knew the episode number, but Chris and I had a great interview at Best Ever Con, and I dare say that's when these, we decided to date for a little bit before we all got married together and jumped into the Best Ever CRE pond. But that was a great interview at Best Ever Con, which by the way, they call that Best Ever Con for a reason. That's the best ever conference you're ever going to go to. So all y'all, what are you doing? Get out there and buy your tickets. That's your Best Ever Toolbox tip of the day right there. I'll reach into the Best Ever Toolbox and tell you guys, Best Ever Con, they call it Best Ever for a reason. Best Ever Con is the best conference out there. So what are you doing? Go get an early bird ticket. That's my tip. But Chris and Richard, let's get into you guys, right? Let's introduce you to our Best Ever listener. I'm just going to go to the Hokie. Sorry, Richard, first. Chris, tell us all about you, and then we'll hand it over to Richard for a quick intro. Tell us all about yourself.
Well, I got to start with the theme. So I actually went to Virginia Tech, went to VT for engineering. Ever since like middle school, I love shop class. I love building things. I love math. I was like, cool, I'm going to become an engineer. Grew up in Virginia. VT's, a top-rated engineering school. Got early decision, got my scholarship there. And within 2 weeks of starting engineering in my fall semester, I realized engineering was not for me. That was very, very apparent when I could barely get through like day one of physics in that first semester. And I was like, oh, my plan changed here. I was going to be an engineer, get a good career, and just live the engineer's life. And so I went through a lot of people did in college, right? You kind of go through the funk of like, hey, I thought I was going this direction. Now I don't want this college degree. What am I going to do? So I spent that freshman year trying to figure out what the heck I wanted to do. And I did not have clarity, but I knew I did not want to sit in Washington, D.C. traffic on Interstate 95 for the next 40 years of my life.
Yeah, man.
Long story short, someone handed me a copy of Rich Dad, Poor Dad. Now, granted, this was over 20 years ago now. This was like 2002 timeframe, I believe. And, Rich Dad, Poor Dad just completely changed my mindset like so many people out there, right? I read the book and I was like, oh, my goodness. What's entrepreneurship? What's investing? What's owning a business? This is the route I want to go. And I actually read the book. Like most people want to get into real estate investing. Well, I didn't have money. The internet was not a thing back then. And I was like, well, I want to get into real estate, but I got to make money first and also go out there and make some money making skills. So I started an internet business in 2003-ish timeframe, online marketing. Had some great partners / mentors for business and life, learned those business skills. Long story short, I built a great little marketing business, was able to graduate college not needing a job. Now I was not making, huge money, but I was enough for a 21, 22-year-old, was able to live off of that. And I kept building that business. And from about 2003 to 2009, 2010, that business was amazing. built a great residual income.
Mm.
And what happened in that business was had great business income. You know, if you've played that like Escape or what's the board game, Cash Flow Quadrant, the board game Rich Dad Poor Dad has?
Cash flow. Right.
Cash Flow, yeah,
101 and 202. I played a lot of that in my career. Yeah, I got it. But you made it out of the rat race and into the fast track of cash flow.
Yes, exactly. You actually,
I'm kind of a Kiyosaki dork. I turned myself in a little bit, played a lot of that game. So yeah, you made it into the fast track. I got it. Right.
And so I thought I did, and I had great business income, you know, continuity income from business, but it was not like a real asset. I was kind of that still self-employed, you know, trap, so to speak. And then the great financial crisis happened. That business income just started going down a cliff. And then I realized, I'm not financially free like I thought I was. So I tried stock trading for a couple years. That was definitely not my path to financial freedom because I was not good at stock trading, like most people. And then I was like, man, I need to get back to real estate. That was the bug I had 10 years ago. Pivoted towards real estate, bought my first rental property in 2011. And it was a house hack. Did a house hack, and that just set me off. I know it was called a house hack at the time, but bought a place, got a roommate, and lived for a couple of dollars a month and built a lot of great equity. But that's when I got bit by the real estate bug. And then from there, I was trying to figure out how the heck do I create a new business around real estate? And how the heck do I buy not just one property, but dozens of property to gain financial freedom? So move forward with that. Did a fix and flip, made money, hated it. I'm a one and done fix and flipper. Tried wholesaling, did not make money. So I was like, okay, that's not for me. And then I joined a boutique commercial multifamily brokerage. There's some ex Marcus Millichap guys that started this brokerage. I joined them. And I was just a junior broker, and they're like, make 300 cold calls a day. I was like, awesome. I'm willing to do that. I can make 300 cold calls a day. And after a couple weeks, like, cool, making the cold calls. But hey, guys, I've sold about almost $100 million worth of stuff online. Can we do internet marketing? Nope, no marketing, only cold calls. I was like, well, that doesn't jive with me. Like, there's no leverage with me cold calling. So as I was going through my evolution, I kept trying things until I figured out what's the right path for me. Well, then I really focused on buying residential rental properties, 1 to 4 units. I was like, hey, that's my path. I don't need to make quick money to fix and flip. And then I realized being an investment-friendly real estate broker was a really good use of my skill set in terms of marketing. I had a financial planning degree from VT, and so I could help people understand how to build their portfolio for long-term wealth building, not making a quick buck, but hard to get rich in 2 years, a lot easier to get rich in 20 or 30 years in real estate, right? So I started focusing on that. And what I focused on was the Denver market, which is where I live now. And I really was able to pour gasoline on the fire by just doing a lot of marketing, a lot of podcasting back then as well, and built an amazing team of real estate agents. And we were doing close to $100 million a year in volume after a couple of years of starting. And that just took off like a rocket ship. Now, here is where I actually met Richard McGirr at some point. So I used to do property walk videos on YouTube, and we were walking, I think, a 6 or 9 unit multifamily property. Of course, we're videotaping the whole thing, right? And it was a property with really cool mural on there, very unique, very, it stands out. Richard was you're living in Hong Kong at the time.
Correct.
You saw the video, and then 2 weeks later, you saw that same property on LoopNet, right?
It was other way around.
Other way around.
Yeah. So, okay, if you go back to it, the way that I wound up in Hong Kong is that I started a marketing firm in college. As with any business that you start when you're 21, it was not the perfect business, but it paid good income. I mean, I think I got up to 4, of course, part-time staff or something like that. I was personally maybe making $6,000 or $7,000 a year. And then actually what happened is that I got very interested in Bitcoin. I got to wind the clock way back. This is 2013.
Oh, early stage Bitcoin, right?
Early.
When it was selling for $3.22 or something like that, right? Yeah.
About 100, 200. Yeah, exactly.
Man, if I could write myself a letter,
No kidding.
I have many. Dude. So basically, I decided that I saw an enormous trend. I just had a lot of conviction around this.
Mm-hmm.
More on that later. I mean, I didn't end up long-term in crypto, but I connected with a lot of like the players at that point in time. One of whom was a guy named Brock Pierce, who became the chairman of the Bitcoin Foundation. I actually wrote a speech for him that he gave at Bitcoin Miami 2013. And so my pay for doing that was conference passes. And I was like, hey, dude, that works. Like any way I can get involved. I mean, he was
got
like
him to just pay you in Bitcoin, right? And just put it on the shelf, forget about it. Yeah, who knows what'll happen?
Yeah.
You know?
Yeah.
Matt, just sprinkle some more salt in that old wound Richard
Yeah.
has there.
No. I can't help myself. Well, now that I know that Richard was an old Bitcoin guy, now I got myself a stick to book him with every here and again, right? So,
oh man. Yeah. Well, I mean, honestly, this ties a lot to what we're going to be talking about later in the conversation. In terms of spotting a really big trend.
But keep going. All of a sudden, you're in Hong Kong and you're seeing this knucklehead Hokie shooting videos in Denver with a mural on it. Take me there, right?
Yeah, kind of like in the middle, I started a management and software consulting firm. I got it up to like 80 employees. And so much like there's not a lot of durable value in a business like that at all. But I had some money to make some investments, was like very keyed into real estate, because like one of the things growing up is that my parents' friends and friends' parents that had a lot of money, like crazy generational wealth type money, was always in real estate. Yep. And so, I had some money to play with from that business. And then I was on LoopNet looking for properties in Colorado. And then suddenly I'm watching YouTube on the Bigger Pockets YouTube channel, where Chris at the time was a host. And I see this building that I'd seen on an OM. And I was like, oh my God. And then he's like, this is how we turn this building, because I could tell it was a really good flip. I watched that. And then Chris just drops, I'm a local investor-friendly agent here in Denver. And which is where my parents had retired and where I was planning to move in a few years. And so, I reached out to him in short order, bought some properties off him. And then actually he had this really crazy spreadsheet that was used for something called portfolio analysis. And what this did is it like took like up to 10 properties, and then you input like the details of like the NOI, the cap rate, the debt on every single property. So basically a full financial model of every single property, and then was able to roll it up to a portfolio level, which is like really important because these are the tools that are like available to like an institutional landlord, sure, but that your average mom and pop does not like have these capabilities, except it's really important. And the stuff that he was simulating on his podcast was like, hey, you have this single family home that you've owned for 10 years. In Denver, you've done very well. You got like $400K in equity. What if you like 1031 this into like a fourplex? Like, hey, your today's cash flow portfolio wide will triple in one move. Now, the problem being is that spreadsheet was like so complicated, he couldn't even send it out. It was like literally 20 tabs. And so he's like, I want to put this online. I was ready for my next thing. And I just called him and I was like, hey, I can put this online for you, because I mean, I owned a big software shop for a while. And then like, I also knew I was moving home and was kind of ready for my next thing. And then like one thing led to another. That software business has done pretty well. I mean, it's a great lead magnet. It's an incredible lead magnet, because the type of person who has that problem, is a high net worth person who really likes real estate. And then on the way back, I kind of hinted at like, I might be looking for a job. And then, I became CTO of Curtis Street Media, which is one of Chris's media company that runs like the podcast and is kind of a holding business. And then I think you can take it from there of where things headed. Yeah.
And actually, I want to highlight one thing on here, because this is a key thing Richard did, right? I was, in terms of my real estate career, I was a couple steps above where Richard was in terms of real estate investing. And I've done this for Smart, saying, hey, I want to get into real estate. I can add value to Chris.
Yeah.
Get in his network and go out there and help Richard scale his business, his portfolio. So he reached out, not like, hey, Chris, can we grab a cup of coffee and can I pick your brain? He's like, no, I can build this app for you. I was like, cool, sure, sounds good. And then 2 weeks later, he does this mock up. I was like, holy smokes, who are you again?
Yeah. It was a fully clickable prototype.
Yeah. I mean, it was legit.
Because you guys hit something that's a hot button for me, right? Best ever listeners. You looking to connect with someone, build your network, maybe even raise some capital in your network, or, ever just make friends. Listen, don't be emailing people telling them, hey man, I want to take you out for coffee. I want to pick your brain. Nobody gives a shit about you buying them a $4 cup of coffee. They don't even offer them a beer, not even dinner. I could buy my own dinner. Anybody that's successful can buy their own dinner, buy their own lunch, buy their own coffee. Don't offer to do that. Offer real value. Offer a spreadsheet. It's good to hang out with smart people like Richard that can, revise and revamp and make things better. We all have skills. I don't care if your skill is the best, duck l'orange ever made, right? Whatever your skill is, even if it's cooking, not real estate, whatever you got, bring something that is one of your God-given talents to help someone else. Then you're really hooking them up. I forbid all you best ever listeners from ever emailing anybody you're looking to connect with and tell them you want to take them out for coffee and pick their brain. Stop it. What you're really saying is, hey, I want to time vampire 1 hour of your time away and just suck out 1 hour of your life that you'll never get back, and I will not give you any value. I just want free advice and an hour of your time. Think about that.
No, exactly. I mean, because I had a pretty deliberate.
I'll step out of my soapbox. Yeah.
No, I totally agree. You're absolutely right.
No, I had a deliberate plan here, like without a doubt, because
100%.
I mean, I'd been in China for like 8 years. I'm moving to a city I've never lived in. I have no network, no idea what I'm going to do next. I was literally, because my primary residence was currently rented out, I was going to land in my parents' basement, like unemployed. And so that obviously was not a good option versus like, I knew I wanted to move into real estate because I wanted to move into a business that like developed durable assets and like actual long-term wealth type stuff. I mean, we know that shtick pretty well. And that I was like, here's this guy, Chris, he's got great distribution. He's like connected to everybody, got a great business in the industry I want to be in. And I was like, okay, I'll just found a business with you. And that was the right move, I think, considering where we are today.
Why? Just because best of listeners, maybe you're screaming at their radio right now, or I just dated myself.
The radio.
What's that? What's that, old man listening to the radio there? Anyway, they're yelling at their cell phones while they're listening to this show, saying, Richard, why'd you walk away from all the marketing and the Bitcoin and all that jazz that you built? Why real estate over those things? I mean, the three of us have all drank the Kool-Aid, but people might want to know, why did you want to transition out of all that Bitcoin mess and all the, hype and hoopla over there and get into boring real estate? Why?
Yeah, I'll tell you why. It's because I was looking, so I'm a serial entrepreneur, you're a serial entrepreneur, Chris is a serial entrepreneur. Mm-hmm. You're always trying to build successively like better businesses qualitatively.
Yep.
And that like, for example, my first business was a marketing firm. Kind of the problem with marketing firms is that like the type of person who buys marketing services is usually a struggling business. There's a lot of adverse selection there. Then I moved into like IT services, which I like because it's like a more sophisticated service. And I was in outsourcing. Like we had like 80 employees in a country called Belarus, which now everybody's heard of, unfortunately. Mm-hmm. The thing at the end of the day, that's like a business that scales with headcount, which is like really tough. I mean, it's really great up to like a couple $1 million a year, which is a great outcome, like for the record. But that it basically, my wife and I, who's my business partner, were just full-time HR managers towards the end. Yeah. And that is like not fun, like at all. So I wanted to move into like a business that had a lot more scale, and we'll kind of like jump ahead. Like the capital firm that we have now, I think is one of the most extraordinarily scalable businesses, and develops like extraordinarily scalable income too. Like, for example, and I kind of say this offhand, not that we intend to follow this, but like if our three partners today decided to stop working, each of us would have an income stream of like over 10 grand a month without having to do anything. I mean, if we like completely stopped working, like that's crazy, and we do not intend to stop. Like we intend to like exponentially increase that income, but that is like, do you know how hard it is to produce 10,000 a month in income without having to work?
Well, it's tough to do it in another industry. I know a lot of people in the real estate industry that are doing that, right? But it's very tough to do that in marketing or in whatever it may be, in other businesses. I know people that are, halfway retired or whatever in other businesses, but it's less common to hear that than to hear people that own a lot of sticks and bricks, where people are paying them because of the asset, right?
Yeah, exactly.
So, okay. So let me fast forward you guys. So you guys now are buddied up. You're going from Richard creating a phenomenal spreadsheet for Chris, delivering his talents to Chris to show value, right? So you guys, what happens? You start doing some deals together as partners. I know you were a buyer of a client of Chris's on the brokerage side. When did you guys lock arms as business partners, and where did you carry it from there?
Yeah, so I'll take one step previous to that because that will feed into it. So I think a year or two after Rich and I connected, when he was just buying rentals and still running his business overseas, with my friend who I was doing a lot of the property walks with. I was working with him to learn how to scale from residential to commercial multifamily, kind of going from 1 to 4 units to 5+, which is, 2 different oceans out there. And so he started syndicating deals. So I started learning about what's a syndication, what's this. I read, of course, Joe's book, a lot of other people's books were out there to learn about it. Then I started investing as an LP in a couple of my friends' deals. Just, hey, this looks cool. Here's $25,000. Here's $50,000. Let me just invest and learn. And after like a year of that, I was like, holy smokes, this is amazing. I'm making the same return as I would as a rental with a rental property, but doing, a fraction of the work. And of course, taking, no personal liability, no personal guarantees on there as an LP. As I learned more and more about the business model, I was like, wow, these deals can scale so much more than like what I could do with like a residential portfolio. And so I started really learning about that business model on, hey, how do you go out there and do a syndication? How do you go out there and put together a fund? How's all the stuff work, right? And of course, Joe and the Best Ever Network were part of my education through all that. Mm-hmm. And after about 2 years of being an LP, I was like, okay, I feel like I've got some education from learning. I've invested in a few deals. I'm starting to learn how to do it as well. And I will always invest first, to learn before I go on like the GP side. But I knew I wanted to move over to the GP side because there's so much more scale. And that's where I want to take my business. Yeah. And of course, cash flow was starting getting tight in Denver residential. And I was like, all right, this is the next big thing. It's a lot more scalable. So started investing in deals like that. And then one of my mentors out here is actually, Lon Welsh, who was on, I think you interviewed him a couple months ago, Matt.
A couple weeks ago, Lon Welsh, great conversation, right?
Yeah. Brilliant guy. He was actually the founder of the brokerage I was at, and he was a business mentor to me, an investor mentor, and one of my key ones out here. And then he'd sold the brokerage, and he was looking to go out there and start his own capital group. And he was focused on, hey, how can we help all these people that want to invest in real estate or transition from active to passive? And he knew what I could do. He knows I knew marketing. He knows that I knew investment, real estate investment. And of course, I was like a top 5 agent in a 700-person brokerage. So he knew I could produce. He was like, hey, Chris, do you want to help me launch my capital group? And I was like, heck yeah, I do. That would be an honor. It would be a privilege. I want to be with someone who's smarter than me and more experienced than me. And he's got a great reputation. So I was like, yes, I do. I can't do it on my own. I need my team with me as well. And Rich at that point was already a very key team, member. And then at that point, he and I became general partners with Lon and his new capital group. And he said, hey, guys, just go out there. I'm going to go source the deals, go out there, build the marketing, build the funnel, build the fund administration. And we built a lot of the front end stuff, a lot of the back end systems.
Our job ended when the wire cleared. And there's like, that encompasses marketing as well as like the onboarding parts of the fund, which is also very complicated. Like getting.
Can we just pause real quick and talk? I just want to, for the Best Ever listeners, that want a little bit of clarity here, right? So what we're talking about is we're bringing dollars in through networks and through online marketing and through, pay-per-click. Richard, were y'all doing pay-per-click too?
No.
Okay. None of that. All right.
So this was all through our personal network at the time.
Oh, all friends and family, air quote, friends and family dollars, right? Personal network.
Friends and family and podcast family.
Yeah.
Yeah, I got it. Bringing dollars in. It's all one big, right? One big. Every friend I have on Facebook is my family, right? That's what people say, right? Yeah. So bringing all those folks in to deals that was there an acquisitions department separately from you guys that were finding the deals? Was that the equation?
Yeah, they had an investment committee that was finding the deals, underwriting them. We brought a few sponsors from our network as well, but they were doing all like the, checking all the numbers, doing all that. We were doing a lot of the front end and absolutely loved the model. And we had huge success. I think in about the first year, we raised just over $40 million between equity and debt deals. And it was an absolute blast. We put together some amazing deals and realized, wow, this is it. Now I want to pause here and I want to rewind a little bit because, Lon was not the first gentleman who had asked me, saying, hey, Chris, can we go out there and raise capital? Can we go out there and do some of these big deals? I had, I'm a local Denver real estate investing influencer, for lack of better words. And I had dozens of people saying, hey, Chris, help me raise for a deal. But I was like, no, I want to make sure, because when I partner with someone, the guilty by association. You're also successful by association. I wanted an A player because we're all A players here. And, Lon was an A player.
Right.
So we said, hey, this is a great fit. Let's go forward with it. And then we just absolutely had a rocket ship in the first year. And we really learned how the business worked. Mm-hmm. We learned all the legal structure. We learned, all the nuances. We also, I think most importantly, built the confidence that, hey, we can do this A to Z ourselves. And, with my network and the software company that I built with Richard and our third partner, Alona, we had lots of opportunities and lots of ideas. So we hit a point about 2 years ago, we're like, hey, it's time for us to kind of go off on our own. And then you want to pick it up from there, Richard?
Let me get
go ahead, Matt.
But hang on, I want to just get there's got to be some really great lessons that you guys got out of working at that organization. Because this is what, guys, best ever listeners, sometimes working for somebody else is okay if you go in to learn, right? And so when you guys worked for that organization, right, helping them raise capital for deals that they were finding and whatnot, there's lots of great lessons. Richard, give me one big aha takeaway that you got that you're able to carry over to Property Llama, to your new ventures and everything like that. Like the big, big aha moment. And then Chris, I'll get yours. But Richard, you go first.
I think that the biggest aha moment was the type of fund he did is that we did not directly own any of the assets. And you would say, how did you do that?
I'm over here asking that question in my little head. How did you do that?
So we were what was called a fund of funds, actually.
Okay.
Yeah. And so the reason that Lon chose that was that it enabled us with the smallest team to deploy the most amount of capital. And also because we knew how to select great operators. There were great operators who needed our capital. And so there was a natural partnership there where we could form, instead of being on the co-GP, what we did is we would form a special purpose vehicle or a fund in the middle. Yeah. We would aggregate a bunch of $50,000 to $100,000 checks. Also, these large institutional sponsors we were working with would not take 50 and 100K checks and did not want to do that. Yep. And so we added a lot of value kind of on both sides by offering our audience opportunities that they otherwise could not get into, had been vetted by very successful investors and a proper investment committee, thoroughly due diligence. They walked all the projects, checked all the construction budgets, did everything like that. And then basically we were able to raise into our vehicle. We were compensated from our vehicle, not from the sponsor. And I don't want to get technical into the legal reasons for that, but that it was a highly compliant framework to...
Well, I'll tell you real quick why it's a good thing, because the SEC, doesn't like doing it the other way, because you're not running around with a broker-dealer license. Best ever listeners, I want to unpack something real quick, because, we all got to teach on the Best Ever podcast, right? So listeners, check it out. If I raise money into Chris's deal, because he's a swell fellow hokey, right? And I go and raise money from all my friends and family, and they then go or invest directly into Chris's deal, that is a co-GP. And if I don't play my cards exactly right and walk that tightrope, what I just did, I just sold securities without a license. That is something you're going to get a little bit more than a smack on the wrist. You might get something else on your wrist if you do that the really, really wrong way, right? There's a lot of people out there doing it. I'm not judging it. We have done it that way under the co-GP model at DeRosa Group, my company, and there's a lot you got to do. There's a stack of paperwork that these folks have to sign. There's a lot of compliance matters they have to do. Right. So what Richard is referring to is the fund to fund model, which is a whole different way to aggregate capital in someone else's deal, and to do it, hey, here's a good idea. How about we do it legally in a way the SEC allows you to do it, right? No problems asked, no questions asked to do it that way. Richard, carry on. Sorry, I wanted to unpack, because people throw out these things, co-GP versus fund to funds. The best ever listeners need to really, because of the direction that your show is going to be taking these best ever listeners and teaching all of us all about this kind of stuff, people need to hear, underscore clearly, co-GP versus fund to funds. You can do co-GP, and people might ask you to do it that way. It's okay, but you better know all the rules and you better walk that tightrope, So Richard, your partner, employer, whatever, was doing it through a fund of funds. What was the average special purpose vehicle, SPV check, that was going into those operators' deals? How much are we talking downstream that went in? Yeah, into those operations that you guys would invest in.
I'd say we wrote checks of 1 to 15 million
Oh.
to the operator. I'd say on average it was probably 2 or 3 million.
Yeah, but
that
think
we
about
would bundle.
that.
And like I said, I know our exact
Yeah.
average check size. It was $101,000.
Think about
Those
the
were our
swagger you
investors
got.
and we bundled them.
Yeah.
But think about the swagger you got that you now could run around and say, hey guys, I can aggregate, 3 million for your deal.
Yeah.
I'm going to do it through individuals that I know. They're going to put 50, 100, 200K into my thing, into my bucket. And then I'm going to take that bucket of water, like a big bucket, and I'm going to dump that into your deal. But I'm going to get people and take little teaspoons and they're going to fill my bucket up full of money. And then I'm going to take that bucket full of money and bring it to you. And I will deal with all these people behind the scenes. That's SPV, fund to funds. We're going to unpack a lot of that stuff, but I want to make sure from a lingo perspective and a operational functional perspective, this, best ever listeners, is the way the hockey puck is going. This is the future of capital raising. People that I have in my network, me building a sub-marketing campaign underneath my umbrella, my people. And then I decide as a fund manager where that money's going to go. So you guys saw the future in the way this is getting organized, right?
That's where I was going with the Bitcoin thing actually a while ago, is that I was like, I spotted like a big trend. And this is exactly how I feel about fund of funds. Like exactly how I feel. And it's kind of the same thing where if you're early and you add a lot of value, you can connect with very big players early on. It's the exact same dynamic.
If I roll in the door to somebody that's raising capital, I'm like, hey, I can, put 50K, 100K of my own money into your deal. That's one thing. Yeah, sure. They sure appreciate that. But if you're like, I'm going to aggregate my network into your deal, and if it smells right to me and it underwrites to me as a fund manager, as the director of capital, so to speak, for this company, if it looks right, I can get you 2 million. Best ever listeners, everyone, there's a book you ought to read called Raising Private Capital, written by yours truly. Everyone has between 2 to 5 million in their Rolodex. You guys are proof of that. I just dated myself by talking about Rolodexes, but hey, in your cell phone, right? There's 2 to 5 million bucks. All y'all know people to put 2 to 5 million into a deal. So why don't you aggregate all that money, do it the right way, and put it into a deal that you've sniffed out, right? So Richard, yeah, love it. So that concept comes out. I know we're tangenting, but go ahead. You have one more thing? I want to get Richard's.
So
I want to get Chris's
aha
too. Yeah.
I think there's another really big advantage over the co-GP model is that I think if you can bring $1 to $2 million into a deal, there's also going to be some adverse selection about who's willing to co-GP with you, because it's a big deal for them and a lot of risk for them to bring you in on co-GP, because you're like now a co-owner of the entity. Versus if you wanted to go into like a really large deal, like a $20 million equity raise, if you're like, I can bring 1 to 2 million and we're this big institutional shop, they're never going to put you on co-GP. They'd be like, I don't know who you are. Versus if you're just like, hey, can you give me slightly better economics if I bring like $2 million to you? And like, I'm just going to be an LP. Basically, I'm not going to say everybody, but like basically everybody will take that deal.
They will.
I would argue that it can get you into like much better deals than a co-GP model.
All right, I'm going to give homework to all the best ever listeners. For those that are inspired by this, they're like, hey, Matt's right. I do own 2 to 5. I do have 2 to 5 million in my cell phone, right? Call somebody big, call a big fish that you know, and say, as Richard just said, if I could get you $2 to $5 million for your deal, no promises yet, but if I got you $2 to $5 million for your deal in passive LP equity, could you give me a little bit better economics so I can pay myself? They're going to say, heck yes, man. All right. So transitioning over to you, Chris, I'm going to put your aha on your table because I kind of sort of know what it is, because you and I used to hang out over there at that fellow organization in Colorado, during a different time, dare I say during the good old days. You and I both were doing it in the 2000 teens when that was a very different organization. Best ever listeners, all y'all know who we're talking about. But you were able to aggregate capital by working with them when times were different, right? By getting attention, right? And best ever listeners, if you guys are courageous enough to get in front of a microphone, if you've got the stories to tell, as the three of us are doing now, get a YouTube channel, get a podcast. Guess what? Your phone will ring. So, Chris, what was that like in doing megaphone work for who? What was there an aha moment there for you in the amount of attention it drew to you personally and to your brand?
Oh, I mean, I got dozens of aha moments from that.
Yeah, me too.
And I think, and to even rewind that, like I still run the Denver Real Estate Investing Podcast. It is a hyper local one here. We get 1,000 listens per episode, so we are not big numbers, but small listeners, but mighty listeners because
pretty
we're
good for a
local here.
for a market centric podcast. Those are great numbers. That's
And so when I really started this stuff, because like I started that Denver Real Estate Podcast to do three things. One was to learn. I wanted to learn myself the market. I am always a learner and I can learn a lot. Like, I forgot to give a shout. Part of my learning journey was actually reading your book years ago, Matt, you're one of the books I consumed, said, yes, this makes sense. Yeah. Well, I have to give a shout out to you. Like I want to be respectful, right?
Thank you, brother. Appreciate you.
The other thing is I wanted to network. And the third thing is like, hey, if I go out there and I'm meeting these great people and I'm networking, it puts me in the center of the action. It puts me in the center of the deals. And back then that was to do, I made my income by doing brokerage deals. And then that transitioned over to then raising capital for deals to, replace that brokerage income I had. So those are like three big things I focused on there. Now, what I'll tell everyone out there is, to go out there and be a successful, capital raiser, whether you're, a GP or you're going to go down the route like the fund of funds that Rich and I have chosen to go down, you don't need to be a mega podcast host like, a Matt Faircloth, or do what I do. Even if you have do some of it, even your own network, you can raise a few $1 million. And that is a lot of money to go out there to bring in a deal, enough to go out there and sustain a new business and grow from there. The other big aha moment I had, and I think this is a really important to note is, when I got that first dollar in the door from my investors, it hit me like a ton of books. Like, oh my gosh, I'm a fiduciary. I have to if I lose my own money, that's one thing. If I lose Donna's money or Kyle's money, that weighs a lot more on me. I think we all saw, I think a lot of people were maybe a little too flippant in raising money, when times were easy, when money was cheap back then. And so my other big aha moment was like, oh my gosh, I'm a fiduciary. I would have sleepless nights, like making sure I would worry about that, wanted to make sure I was a good fiduciary in placing the capital. And so I think it's a very important thing for people to go out there because, hey, it's awesome. It's sexy to say raise all this money. But what's more important to say, hey, I raise money and I put it into good deals. And I did everything I could possibly to make sure I helped my investors get good returns. That was one of my big aha moments. And also, I think it helped me get a couple gray hairs as well,
Me too, man. Me too. I guess I'm going to blame all my gray hair on capital raising, on the sleepless nights, like, oh shit, man, I'm a fiduciary. I'm responsible, and that. So yeah, I'm with you. So, okay. So you guys now left that other organization, lots of lessons you get to carry your lessons out the door with you to get to use them elsewhere. Right. Then the name of your organization at the time, Property Llama, right? Why llama? Why llama drama? Why do we like llamas? Tell me why.
To be really, really frank,
do it.
Because we could buy the domain for $12, not $100,000. We were looking at some of these. We wanted a good domain, a short domains. Oh, $50,000, $200,000. Like, well, that's not top priority to go out there.
It sure is memorable. I'll tell you guys that. But you bought the name Property Llama because of the memory. It's not like, Richard's got 19 llamas in his backyard because his wife's like really passionate about llamas, or there's no backstory about llamas or anything like that. No,
not like that. But the kind of the reason those two merge is, we both grew up, owning rentals, and I thought, hey, I'm going to buy rentals, pay them off, and that was the plan for my retirement one day, right?
Yeah.
And then, as I evolved, the market evolves. Like, oh, that's not the best path forward. So we wanted the word property there because, hey, we bought properties and we were transitioning. And then as we kind of researched, we looked at other animals as well. But I forget the exact, when we looked at like the
we had property guide, dragon that was available.
But llamas are about caring. They're about shepherding. They're about
it's positive.
It's positive. Like, hey,
positive animal.
Nobody has like a bad feeling about llamas. Or I'm not gonna, okay, maybe there's some
they're
weirdo
lovely,
out there.
Right?
Yeah, they're cool.
Like there'll be some YouTube comments out
there.
Yeah, I've heard camels are absolutely nasty animals. They'll spit on you, they'll bite and stuff like that. Property dragons can blow fire and stuff like that, right? So I love it.
It's a little intense. The dragon's a little intense.
Giraffe. I'm not 100% sure how you spell giraffe. So
exactly.
But llama is very clear. Double LAMA, right? Property llama. Got it. Okay, so it's easy to spell, and they're very friendly animals. I got it. Okay, and property.
And nobody forgets. Nobody forgets the name.
No.
Nobody. Because that's another
I
thing
have-
in branding is you want to have like unaided recall, aided recall, etc.
Yeah.
By the second conversation, it's never happened where people are like, what was the name of your company again? It's always, Property Llama. Like, that's you guys.
I had that moment too where I'm like, oh, I remember Property Llama. Yeah, that's it.
Yeah.
Is it good for you guys? Yeah. Okay. So now we got Property Llama. Tell me where you guys are at now, right? Let's fast forward to today with Property Llama, with this fund to funds model that we've discussed and everything like that. And then we'll keep unpacking. Where are you guys at now? What have you guys done on your own under Property Llama?
Yeah, so total year to date, a little over 3 years and change, we've raised just about $60 million total in capital. Little more to debt than equity, but we've kind of raised for both deals. And, our focus with Property Llama was we wanted to really create a win-win-win situation. A win for the sponsor, a win for LPs, and a win for us. So we started really focusing on sponsors that had institutional quality type deals. A lot of times, 50 to 500 million AUM. So it's not their first rodeo. That's, if someone's first or second rodeo or deal, there's too much risk on there. And so we we identified sponsors on there. Of course, as we launched Property Llama about 2 years ago this month, the market was already starting to get very challenging out there. And a lot of these great sponsors had great deals, had great experience. They had the track record. They had their own capital. They had a 10, 20, 30 person employee, but they did not have the resources or the goals to go out there and build their own investor relations team to start, getting, the industry term is, retail investors or small investors, $50, $100, $200,000 checks. They could raise multi-million-dollar checks. So we focused on these sponsors that had great deals but needed capital. They wanted access to smaller, accredited investors. And so as Richard said earlier, we were able to go out there and find great deals and negotiate better terms. And what that allowed is it gave our LPs access to institutional quality type deals that they normally wouldn't get access to. And they actually got the same or sometimes better terms than if they invested directly with the sponsor, because we can negotiate more, just better terms for our sponsors. So win for the sponsor, win, the operator GP, win for LPs, and also a win for us as a fund manager for, hey, we need to be compensated for our time for putting everything together and, legal fees, all that stuff, a win for us as well. So we really focused on that, and we've had just, I would say, really great success so far. And I think one of the biggest privileges, aside from, putting up good returns to our LPs so far, it's like I just talked to one of my LPs yesterday, and he was a former brokerage client that's now doing some LP investing. He's like, Chris, I just appreciate so much all the time you and the team put into it. I appreciate the you guys finding these deals that we never access to. And you get gratification like that because, I know what his goals are for his wife. I know what his goals are for his children to go out there to pay for college, pay for weddings one day. And we're able to go out there and have a really meaningful impact on these investors' lives, which is just it is an amazing feeling and just amazing privilege to get.
I love that. Love that. So here you guys are now, 60 million and growing of dollars at work and other people's deals, top tier operators. What I like about the fund to funds model, as I think about it, this is like the raising private capital guy talking, that you guys can really focus on, raising capital, right?
Yeah.
Bringing a term that we're going to use a lot here, unlimited capital into your show, right? We're going to be into your pockets as a fund manager, and then putting that to work into the world, right? And so I love that. And that's your focus, is raising capital. You're allowing operators that you guys like and trust to do what they do, to go and build their businesses and to build out in-house management or whatever it is that scale looks like for them. And you're able to be a participatory member of what they're doing, through a win-win arrangement. So
yeah, and we have deep relationships with these sponsors. It is not deal by deal, and
we don't find them on a website.
And we're like, hey, we're going to throw $1 million to you and then move on. We work with a small group of sponsors.
It's like, hey man, I heard you
for
on a
long
podcast.
period
Can I
of
give you
time.
$3 million? You know, I'd like the shtick that you said. Can I raise a lot of money for you? Yeah, I get it. There's a lot more vetting that you guys do. How do you guys vet operators? So an operator shows up. Help our best ever listeners, you know, either become an operator that a fund manager would be interested in, or if they decide they want to get into the FOF game like you guys have, how do they find fun? And I know on your show we're going to get into deep dives and all this stuff. But give me like a little taste of some heck yeses and heck nos that you guys see in fund in operators when you guys interview them.
For due diligence?
Yeah. Like I tell
Okay,
you
well,
what, give me a heck yes and a heck no. You see something, you're like, okay, I like it. Not one question answered and you say yes, but something that's a positive and something that might even be, and honestly, if you hear one or two negatives, that might be enough to be out. So what's something that's a positive for you and something that's a negative when you're interviewing an operator?
So definitely some like heck knows this is your first deal. Or second or third deal. Like it's just too much risk, right? Like, hey, we've all done our first deal, and great, we ought to do it. I don't want to do that, so that's a heck no. Another heck no is they're not putting their own money into it, their own capital, not doing the GP co-invest. So those are like, you know, heck no's for sure. Heck yeses are the experience, the track record. They actually have like an established team built with them as well, so it really mitigates key man risk.
So no solopreneurs doing deals out of their basement.
They're like three guys who met and they're all kind of part-time on it. Like we don't do that. We don't.
Yeah,
it's
got to be your full-time. It's your full-time business, your full-time focus, right?
That's a factor. You got to burn the ships. You got to be full-time into operations. You can't. I got to go back to my day job, whatever it may be. Day jobs are great. But I get it. Investing with an operator that's running this thing on the side, and I want to touch that real quick as a best ever listener. If that's you, that's okay. Me, Rich, and Chris are not judging you. That's okay. Yeah. Do a deal, do a few, and then, but maybe a little bit before you think you're ready, exit from that day job so you can put the pedal down and fund the deals that you got with your friends and family, with like your Uncle Charlie and your own mama or whatever you got to do, and your best friend from high school. Get a few deals done to build a track record, take a few acquisition fees and take those fees and quit your day job so you can go out there and get taken more seriously by people that see that you're doing it full time. Anyway, stepping back off the soapbox.
Because I just want to say, like, the nice thing about being a fund of funds instead of like being vertically integrated is we have an enormous amount of choice of where to put our money. That is not the hard part.
Yeah.
We are coming to the table with a lot of value, and frankly, if you're coming in with $1 to $2 million checks or more, there are not a lot of people who will not take that check.
Yeah. Well, the difficulty I see in real estate investing over the last 2 to 3 years, maybe even 4 years, has been finding deals. Right. The challenge has been in finding deals. There's still equity out there looking for a home. People still want another way. People still want to get wealthy outside of Wall Street. They do, but.
Yes.
There's just not that many deals out there. Every deal, sellers are still wanting, low cap rates. There's still loan workouts happening and all that. So if you've got a really diligent operator that finds a great deal, I'd rather be finding operators than I would be finding deals right now. Finding operators that have great projects that are well underwritten and that you're able to do the due diligence on and probably say no a lot until you say yes.
Oh. Well, that's like anything. It's just like, I don't know what your deal funnel is, but you say no to more deals than you say yes at the DeRosa Group, right? We say no more than we say yes to operators. And, one of the things that one of my aha moments I was going this journey years ago is I think there's two main sides to everything. There's the deal side, finding the deal, operating the deal, doing all that stuff. And there's a capital side. It's very hard to be amazing at both. And usually a lot of people have to do both at the same time until they scale up to a certain point. And we're like, hey, we can find amazing deals. We know how to underwrite deals. We know how to like vet deals and do all the DD on there. And we really chose to focus on, the capital raising, the education, the investor relations side, because that allows us to scale a lot more and ultimately find better deals for our investors because, we can partner with, the Matt Faircloths and those people in the world who are just better operators than we are out there.
Yeah.
And then
I think I would jump in here. I mean, the capital versus deal is very much a chicken and egg thing, like quite obviously, is that you can't do it without both. However, we made the assessment that like we can just focus on capital and then finding a deal is not that complicated if we're just a capital partner. Like, and so that we can build this side of the scale. And then who knows, like maybe someday down the road, 5 or 10 years later, like we may vertically integrate or actually JV on a project. But for now, we can like just focus on the capital side, and then we will always have a place in this industry. That is how we feel.
So transitioning to who makes a good, like, so if somebody's thinking about, this fun to fun thing sounds pretty cool. I think Matt's right. I do have 5 million people in my phone. Who's a good FOF manager? For somebody that is like, I am going to drink the Kool-Aid. I'm hopping in. I'm going to go and aggregate money from my network, and I'm going to go find A+ operators to put that money to work with that I've vetted and do the due diligence and vouch for and all that, right? Who makes a good FOF manager in your estimation?
Actually, I've done a lot of research on this. Like I said, this is like an enormous trend that I'm like very invested in. I mean, I just see the amount of money being raised by fund of funds managers growing exponentially for the foreseeable future.
I agree with you.
And like as a major revolution in this industry. And so like that's the things that I'm attracted to, because I mean, I really like innovation. I was a software guy. I used to be a venture capitalist.
Right.
Like I see this trend and I am all in. And so I've actually been working with a pretty big player in the space to try and like identify who is the best fund of funds manager. And so here's kind of what we've come up with. I'd say broadly speaking, there's 3 or 4 things that you should check the box on. Number one, and this is like everybody on this podcast right now, like, I mean, like the people speaking right now, is serial entrepreneurship is a really important thing. And the reason is because like, this is a business. Like if you want to like do one deal, I guess, and it's side income, I guess technically that doesn't have to be the case, but the fact of the matter is like, this is difficult. Like this is not easy. This is like a lot of blood, sweat, and tears to figure this out, to get momentum. Like it's very much a flywheel. And so like having that background and mentality and character traits of entrepreneurship, when we've done the studies, all of the most successful people, because like many industries, this is like a very power law thing where there are some people that are like fabulously successful. All of those people were, serial entrepreneurs. That's number one. Like that's a very, very good indicator that you will be successful. Number 2, I would say that you have ideally done both active investing and passive investing. So you have been an LP and you have been an active investor. This is very important for building credibility. Also, your ability to DD deals, know what you're talking about when you explain money to LPs. I mean, explaining deals to LPs in order to like get their trust and have them invest with you, because that is a like key kind of turn of phrase that you want to be using is you are investing with me. And because we're all investing together, we're getting like better terms or into better deals.
Yeah.
Also, I think the active real estate part is important because then you can kind of explain to people why you've seen the light and why you feel passive is better and that I'm doing passive now. That also makes it because if you have been an LP, you understand how these things work. I mean, in terms of like what is a PPM, what is an OA, how does all the taxes work? Because like you're responsible for that. Like if you own an SPV and you're running an SPV, you have to do everybody's taxes every year. You have to be compliant, and that if you mess up your taxes, like it's like if the IRS comes after you because you were late, like filing an extension or like doing your K1, it's like a huge fee per member per month, and you can like be hit with like a $30,000 penalty.
Well, hey, Richard, before we scare the shit out of everybody, okay, there are organizations that will do these things for you.
Yeah, yes, they will.
Yes.
Yeah. I'm not saying, because people are already like, okay, no listening. I'm not a CPA. I can't be doing people's taxes. I can't, whatever. There are organizations that will make this thing stupid simple, but understand you are also
you
liable.
You got to know it.
Well, yeah, you got to make sure it gets done. You got to know what needs to get done, and you are liable to make sure that it does get done. That's your job as a fund manager, to make sure people's dollars and cents and their tax matters are taken care of through the K1s that they need to get distributed and everything like that. So, so those are good fund managers, right? All right, Chris, let's go. What's a bad fund manager? Somebody listening to this show, either I'm not necessarily going to talk them out of it, but what is either the wrong attitude, the wrong mindset, or perhaps the wrong equation for someone who maybe ought to not consider being a fund-to-fund manager?
I think the entrepreneurial thing is one of like the A-level things. Hey, are you an entrepreneur, whether you're a successful one or you have the entrepreneurial bug, like that's a big one.
Yeah.
Another one is people who don't have that just fiduciary mentality of like, I gotta go out there and I gotta be a fiduciary. I go out there and find good deals. And also people that like, this is quite a few steps above being like a realtor or a broker. Becoming a broker, real estate broker is fairly easy, right? A few $100, 100 hours worth of classes. You can go out to become a broker. And a lot of people do as a good side hustle. You have to be a few steps above, like, oh, I'm gonna be that broker on the side hustle. Great, that works for that model. For this, since it is a lot more sophisticated, you have to have, I'd say, more attention and say, I'm gonna commit to this for years to go out there and make it work. And be prepared to get punched in the face. I think we all know that in real estate investing. If you can't, take the punches with the market, don't do it. So those would be the things where I have seen people not do a great job at raising capital.
Love it.
Is there anything on there, Richard?
I would say you have to be prepared to fully commit, which I'm just repeating what Chris said.
I'll just put it in one word, man. If you're a dabbler, forget about it. If you want to dabble, if you're checking out this thing today and you know that you're going to go and try and buy a self-storage center on Tuesday and do fund to funds on Wednesday and go buy a raw land deal on Thursday. And I'm looking at myself in the mirror because I'm a recovering shiny object chaser, right? So at the end of the day, if that is you, that you can't focus on this thing, then you're certainly not going to get to where Richard and Chris are, where you're sitting on $60 million at work on other people's deals. Do the algebra on the amount of revenue you can make if you're able to raise that, but it takes focus to do that. So if you're willing to commit to focus, I think this can be done by most people, right? So guys, there is an equation of scaling fund to funds. I get, maybe your first fund to fund deal for a best ever listener wants to get into this thing is, maybe 500, 500K, $1 million, that I've heard that's the economy of scale. That's kind of where it starts to make sense fiscally, is after over about 500K is when you can start to make reasonable money doing that. Right. What does scale look like for the best ever listener? That's maybe they want to get in, they do a 500K to $1 million, $2 million deal and a contribution to a larger project. Then they want to scale. What are the next steps they take from there after they've done that very first one?
So I think what it comes down to is this is like fundamentally a sales and marketing business. I mean, it is capital raising. This is what we do. And so that means that you have to build like a self-sustaining funnel. And what I mean by that is that you have to be constantly increasing the awareness of your business or getting new leads, new blood, new people hearing about you. You have to have a systematic way of nurturing those leads and then closing those leads. Like that's what I think because if you're like, I'm just going to work my network, your network will run out of money like real quick. So by definition, you have not scaled because like, okay, there'll be some like tail level of funds that you can raise every year, and this happened with us, you will get all of the low hanging fruit very early. These are very large checks. Most people are not in a position to just throw you 100K every single year. I mean, a lot of people are, but what you really need to be doing and what we spend a lot of time doing is figuring out how to get more exposure, more leads, converting those leads to our email list, nurturing them with content, using webinars to convert them into LP checks, running a sales team. Eventually you'll get to the point where you have to run a sales team. We do.
Yeah,
and so I'd have to say you have to have that entire thing working out. And it's like, you can't just like be really good at closing without having a bunch of leads. And you can't just be really good at getting a bunch of leads without knowing how to close them. And so like, it's getting that whole thing. Yeah.
But there's the, I was interviewing Cameron Harold. Right. The COO guy, phenomenal, former COO of 1-800 Got Junk. And we got into a long conversation about the flywheel, right? From good to great, right? That concept. And for most fund to fund managers, more capital is that flywheel, right? The more dollars you can put to work, the more greater deals you can do. And then, as you said, Richard, the better team members I can hire, the more sophisticated as a business I can run, the more efficiency I can create. And before you know it, I build all these things and more capital is coming in, and there's your flywheel. And it's like, oh geez, I just raised, $10 million last quarter, for my business. I can now hire more people. I can pay myself more. I can then do more projects. And you get to that point where the business starts just flywheeling and feeding upon itself. The more capital you bring in, there's a point you get there, you got to scale to get to that point, but it is possible.
Well, I would actually the flywheel is so real. And it's actually because on any given deal,
it's a real phenomenon. Yeah.
Well, because on any given deal that we raise, 50% plus of that money is repeat investments.
Yeah.
And that grows and grows and grows. like I said, you can't only rely on repeat investments, but like if you kind of extrapolate that out, getting someone's first check is like by far the hardest, and getting the second, third, et cetera check from them is like dramatically easier. And so like it's very much of just getting people's first checks, and we track that in the business like on our Salesforce dashboard is like how many people's first checks did we get every single month. And then like oftentimes we'll get the second one within like 3 to 6 months, you'll get a second one. Yeah. And so like that's just a huge base of people where like it's you got a new deal. Who do you call first? You call the people who invested in all your other deals. You fill up about like half to 2/3 of the raise with that. And then you like you're nurturing all the new people and they come in.
So best ever listeners, I want to just throw it out there, right? Richard and Chris are running, bordering on a $10 million operation, but they've also been kind enough to join us on the Best Ever CRE team to run their new segment, Unlimited Capital. And here's my 2 cents on the concept of unlimited capital, guys. There is unlimited capital. I saw this in all things a Tom Clancy book. Right? Remember Tom Clancy, the spy novel guy? I've read a lot of most of his books.
I read all those books.
Yeah, me too.
They're all a lot of them are movies now, right? But he said there are a number of unlimited resources in the world, right? Unlimited deals, unlimited capital, right? Unlimited contacts, unlimited ideas, like unlimited inspirations coming from the ecosphere, right? The one thing that you are limited on in life is time, right? That's it. That's all you got. Everything else is unlimited if you choose to look that way. So unlimited capital, in my eyes, is all about Richard and Chris spending their time here with you guys, helping them teach you how to unlock the unlimited capital. Because maybe it's not 3 to 5 million in your cell phone. Maybe it's 30. Right? Maybe there's even more. Maybe through doing a few deals and getting that flywheel that Richard referred to going, maybe it is 30, maybe it's 50, maybe it's more, right? Maybe you can build a business around this thing and get a little piece for yourself and a nice, juicy little acquisition fee or due diligence fee when these deals close, plus a residual piece of cash flow each month as these deals produce profit, right? That is something that's possible for you, but without instruction, without some mentorship, without someone investing their time into you, you're likely, you get a 50-50 shot of getting there. So I encourage you guys to tune in to the Unlimited Capital segment on the Best Ever CRE show and listen to what Richard and Chris have to say, right? That's my 2 cents. Richard and Chris, both give me like one segment, one thing that you're excited that you want to bring to Best Ever listeners as a part of this show you guys are bringing to the Best Ever CRE network.
Adding value. I think this has been one of my my secret sauces over the years. I'm gone 20 plus years of using marketing and internet marketing to go out there and create businesses and create value. We all talk about going out there and buying a multi-family value add property. How to add value to the property to increase the NOI. Something I've always focused on. And you hear the marketing gurus, leads and this person's worth so much dollars out there. I think a lot of people forget that every single investor, every single dollar is represented by a real human being. Right. Mm-hmm. Especially we're not institutions. We are working with, just fellow people like us. And I am constantly reminding myself, we're constantly reminding our team that we have to add value to every single person. That's education. That's making sure we help them hit their goals out there. And that's a big reason we have had success over the years. And that's a big thing we're going to, bring to the Best Ever network as well, because we've gotten a lot of value from Best Ever over the years, a lot of value from, Matt and Joe over the years. And, part of it's paying it back. Part of the way you keep growing is if you add value, good things will happen. So we want to add as much value as we can because karma will help us all become more successful and more wealthier together.
Yeah. Richard, what do you got, man? What are you looking to bring?
Definitely what I've learned here is that there is a way to do this business. There is like every single step of this is repeatable and can be taught. And then also, like you said, unlimited capital. I'm not afraid of teaching this stuff because like we basically raise all this money in Denver, like period. And even in Denver, our market share is like what, like 5%?
Yeah, probably less than that. Even.
Yeah, like nothing.
It's such evidence that it's unlimited. You guys raised $60 million, mostly from investors in one city, right?
Well, within 20 miles radius.
Like almost all of it. Let's be clear.
Yeah. Right. But that's a drop in the bucket compared to the amount of capital there is looking for a home in the city of Denver, right? And think about what's in the US, right?
Actually, I have a stat. Accredited investor households control about 30 trillion in wealth. So,
Yeah. What if you could
It's a
get
big pie.
0.001% of that to
Or maybe
work
it was
in
3
your
trillion,
business?
but it's trillion.
Yeah.
The keyword is there's a T there, and it's really
It's a
irrelevant
T,
if it's 3.
not an M
if
or a
it's
B.
30 or 3, something like that. 5 trillion, maybe. I don't know, but it's like an enormous amount of money out there.
Yeah,
So
I've heard a lot of stats. There's a lot of cool stuff. I'm hoping you guys jump into the whole self-directed IRA conversation on how to
yes.
unlock the also T word trillions that is locked up on that awful place of Wall Street at work on Wall Street, making your financial planner lots of money. Let's unlock those dollars because those self-directed IRAs could get put anywhere, including into your fund of funds. Everyone in their network, everyone listening to the show knows someone who used to work at one job and now works at another job. And if that equation's there, if you got anybody in your phone right now that used to work at job A and now works at job B, the retirement account they had at job A is now ripe to become a retirement account investment into your deal as a self-directed IRA investment. I know Richard and Chris will unpack a lot of that for you guys on this show, along with how to raise unlimited capital, but also where to put unlimited capital. Once you've got those dollars flowing into your business, how do you that operate? These are these are open-ended questions that if y'all want the answers to these, guess what you got to do? You got to listen to Richard and Chris' show, right? Where do you put this money to work? How do you vet operators? I'm sure there's a lot more conversation that we could have here on due diligence on operators, bad operators and also good operators, right? So we're going to be bringing good operators onto the show so you guys can meet them. We're also going to be bringing phenomenal capital raisers, even lawyers, to make sure you guys do this thing the right way, the legal way, because there is the right way to do this. So don't go running out there and raising money yet. Listen to Richard and Chris's show because it's going to be the exact roadmap that you guys need to raise unlimited capital for your business. Richard and Chris, it is always my pleasure to hang out with you guys. Really enjoyed calling you guys friends in my personal network now. Bring me home. Bring me like any other last words you guys want to give to the best ever listeners before we turn you guys loose.
Well, besides go Hokies, of course.
Go Hokies. Thank you.
Go Hokies. Well, I'll know better than that.
Can we make Enter Sandman your entry song for this show? Would Richard tolerate that if we played Enter Sandman a little bit of?
If you guys are willing to pay for the royalty, I can go for it.
I know.
Matt, we got a 2-1 vote here. We're good, man.
Yeah.
We're democratic here. We can outvote him.
That's it. Right.
No, I mean, just like I said, I am we are very somber, we're very serious when it comes to starting a business. Again, being fiduciaries of capital. We all know the measure twice, cut once mantra in real estate. And it is so true, even more true. And raising capital is measure twice, measure 3 times. Spend a lot of time educating. One of the things I'm excited about, and this goes back to the original reason I started the Denver Real Estate Investing Podcast, was go out there to learn and network. We can bring value, which I'm excited about. I'm most excited to go out there and learn from other people. Every time I talk to someone, I always take away one nugget. So I'm excited to add value, meet new people, but also go out there and learn more for myself, learn more for our team, and sharpen our saw even better.
Okay, I got
Richard, final thoughts.
Yeah, you should run a investing with your IRA webinar once a quarter. We do.
Yeah, seriously. Best ever listeners, do that. That's your homework, by the way, best ever listeners. Yeah. Go out there. This is in my book, but make yourself a list of people that you know that used to work at job A and now work at job B. Not for nothing, go do that. And then call those people. Because guess what? They didn't read Rich Dad Poor Dad, maybe are not lucky enough to listen to this show. And so they don't realize that their IRA could be in something else aside from on the roulette wheel of Wall Street. Right. So there you go. That's Richard's homework for you guys today. We're going to talk a lot more about IRAs on this show. Best ever listeners, I hope this is a value. And I know for a fact that the unlimited capital segment of the Best Ever CRE show is going to be of tremendous value for you guys on a weekly basis. So what are you guys doing? Program this show into your phone. Save the date. It's going to be on a weekly basis today. Today, the day you're listening to the show, I don't know the day off the top of my head, but the day that this show is being broadcast is the day that the Unlimited Capital show will be out there to the world, right? So mark a calendar for that and subscribe to the show. Tell your friends about it. For those of you know that are good marketers that also have a deep network like you do, forward the show to them. Say, check out these 2 guys, Richard and Chris. They got a lot of good things to say. So let's all make some money together and build a phenomenal best ever community so we can go out there and show those in our network a better way to make money and achieve their financial goals. That's what this whole thing's all about, right? Until then, I will be listening to Richard and Chris's show Unlimited Capital on a weekly basis myself. Always got to sharpen my saw. So I'll be there listening. Hope you guys will be too. Until then, best ever listeners, have the best ever day.